Investing in the stock market might seem like a very risky endeavor, but it honestly is probably one of the best investments you can make at any point in your life. If I had simply started investing when I was 18, just dollar cost averaging small amounts every week or every month, I would most likely be a millionaire by now. This video is all about how to build long-term growth through compound interest, which is essentially when your money builds upon itself if you just let it sit, a snowball effect. And when you leave your money in the stock market long enough, this snowball effect is what builds wealth. So I like to think of investing as growing your nest egg, building something substantial. You are taking your money that you've earned from a job or a business, and you are putting it into other businesses and other asset classes, and you are just letting it cook, letting it just slow roast in the oven. And over a long enough period of time, that slow roasted pork in the oven will turn into a succulent family feast for generations to come. For 99% of people, there's a famous Warren Buffett quote, okay? If you're gonna take advice about investing, you should probably take advice from billionaires, not some dude on the internet, right? Well, I am just the vessel for information. I am just the messenger, okay? Don't shoot the messenger. There are people way smarter than me in investing, and therefore we should take their advice. I am simply making you aware of that advice. Warren Buffett once said, in my view, for most people, the best thing to do is own the S&P 500 index fund. The trick is not to pick the right company. The trick is essentially to buy all the big companies through the S&P 500 and to do it consistently over a long period of time in a very low cost way. So what's an index fund? An index fund is essentially a basket of the top companies on a stock exchange, the S&P 500, which Warren Buffett always famously quotes. It is simply an index or a basket of the top 500 largest companies in America. So why does Warren Buffett recommend index funds for most people? There are stockbrokers, there are financial advisors that struggle to beat the market, the average market return, which again is around 7 to 12%. I like to use index funds in my portfolio as a core. 70 to 80% of my portfolio is strictly index funds. In Australia, we call them ETFs. They're called exchange traded funds. It's basically the exact same thing. And then on the outside of that, I have satellite positions, which I call satellite. So I take this core and satellite approach. And that consists of roughly 20% of my portfolio. And a satellite is essentially individual companies that I think can outperform, or individual thematic or like smaller ETFs or index funds that consist of a lot less companies, and it's more narrow in a certain sector market like technology, healthcare, cybersecurity. When you want to build a well-diversified portfolio, it's impossible to predict the market. It's impossible to know exactly what the market's going to do. Nobody knows. Lots of people like to tell you that they know, but nobody has a crystal ball. Therefore, it is not possible to know exactly what the market is going to do. People who have been investing for decades and decades. Take Warren Buffett, for example. Charlie Munger. Market can remain irrational longer than you can remain fearful. So the market can just continue to do its own thing, despite what everybody says. Everybody's been calling for recessions year after year after year. Where is it? The stock markets are at all-time highs. They continue to go up. Yes, we can see recessions, and yes, prices can fall, but the stock market goes up more than it goes down. And as long as you're invested for a long enough period of time to ride out those dips and buy more when it dips, you'll be sitting pretty in the long term. So if you're trying to get rich quick, just click off the video now. So therefore, to build a well-diversified portfolio, you want to be exposed to certain sectors of the world. So countries, for example, where these companies live. So you want to be invested in Australia. You want to be invested in the United States. You want to be invested in emerging countries like China. Because you don't want to just have your portfolio dependent on one specific country, because you don't predict exactly which country is going to be the dominant force. So how to actually go ahead and start investing in shares. To build a share portfolio using ETFs, you want to start off with home. Okay, what's home for us? It's Australia. So you would buy something like the VAS 300, which is the Vanguard Australian Shares Index. Now in Australia, we have something called Super, which is basically the same as a US IRA or 401k or whatever it is. It's your retirement fund, and majority of your retirement funds actually already hold a lot of these indexes because they understand it's the best way to build long-term growth. So VAS is a stock standard. It just tracks the top 300 shares companies in Australia, and you can come into and just research all of this information on the Vanguard website. Vanguard's been around for decades, very reputable, one of the best share investment companies in the world. Now, if you want to invest in US shares in Australia, the best US share ETF, without a doubt, is IVV. It has one of the lowest expense ratios or management fee that you can get. And it's domiciled in Australia, meaning the tax jurisdiction is in Australia. It's not in the US like some other ETFs. Some other ETFs are tax domicile in another country like America. And that means you have to fill out a tedious form every time you go and do your, have to file for taxes, basically. And it's better to just avoid that shit because you don't need that. This is about long-term passive investing, and you want to slowly build up money and just trickle it in every month, and you don't want to have to think about anything else. So that's the best way to build long-term growth outside of your superannuation. So IVV is the S&P 500 ETF. It tracks, the top 500 shares. So I would add this to my portfolio as well as a core, part of my core. Same with Vanguard VAS 200. This is part of my core. This is part of my core. Now we've got VGE. You can choose to add emerging markets if you believe that emerging markets is something you want to be exposed to. So these are markets that are emerging. So they're not solidified like the United States yet, for example. So as you can see, they include countries such as China, India, Taiwan, Brazil, Saudi Arabia, and these are the percentages that make up the fund. That's the exposure. Those are the sort of countries that you're investing in. And what are you actually investing in China? Well, generally it's the top companies on the relative stock exchange for that country. And you can come down and you can look at the top holdings and you can see, okay, so 8% of it is the Taiwan Semiconductor Manufacturing Company. You've got Tencent Holdings, you've got Alibaba, etc., etc. That would be, so emerging markets would make up a satellite position, roughly 10% of your portfolio, or you can add it to your core. Because it's an ETF, it can work both ways. Because it's an ETF, it's well diversified across multiple companies. So it can honestly form part of the core of your portfolio. If I were choosing a particular ETF for emerging markets, I would personally pick VAE, as I believe the Asian markets have a bit more potential than some of the other countries in the emerging market ETF. As you can see, it includes Korea, Hong Kong, Singapore, Malaysia, Indonesia, Thailand, Philippines. I believe these countries have more potential than countries like South Africa or Mexico or Brazil. That's just my opinion. There is another ETF that comprises the US stock market and other countries combined into one fund. It's called VGS, and it's the International Shares ETF. However, the majority of this ETF is actually the United States IVV, S&P 500. It makes up roughly 75% of the portfolio of the ETF. That's just because the United States S&P 500, whether you like it or not, it is the most dominant and global market in the world. Not only do they have the biggest and best companies, but they make their money from the companies make their money globally. So when you're investing in the S&P 500 on the top American companies, the way I see it is you're not just investing in the American companies, because these companies get a lot of their revenue worldwide. So you are investing in the world just by investing in the S&P 500. And it's a much more efficient way to invest, in my opinion. Now, for me personally, and for most people getting started, there is an absolute information overload in this investing space. Every ETF provider is trying to sell their ETF to you or market their products, and you can go down the rabbit hole and you can spend months and months and months researching, like I've personally done. What is the best portfolio? What is the best ETF? And when it comes down to it, guys, at the end of the day, it doesn't really matter. You're just splitting hairs. So this is why the best recommendation I can give is to just go ahead and buy the Diversified All Growth ETF from BetaShares. It's called DHHF. And what it comprises of is pretty much everything we've just talked about into one simple fund. Now, there is a caveat though. I would use this as the core. Yes. So you can add other funds to this to emphasize certain areas. So what I like to do is add DHHF as around 50% of my portfolio. That way my portfolio is covered. Rain, hail or shine, I'm exposed globally to the entire world. And then I add the IVV as an extra 25% on top of it to emphasize US shares more because it's such a powerhouse. If you take a look at the returns of the past 5 years, the US stock market has returned 94% on your money. DHHF is an all-in-one investment solution with a 100% allocation to shares. As you can see, it's 37% in Australian equities and then 63% in international equities, comprising up of US equities, developed world equities, and emerging market equities. Equities are shares, stocks. Now, I go one step further, okay? Now, instead of buying DHHF, I actually buy GHHF. What is GHHF, might you ask? Well, it is a very conservatively leveraged or geared version of DHHF. Now, I'm a big believer in using other people's money to get rich, essentially. Now, leveraging is how you use other people's money. Now, there is a small fee for the convenience of ETFs or index funds, and generally they're very low cost. We're talking about 0.1%. 0.1%, roughly around that mark of the fund. And it is a very small amount, but it is completely 100% worth it. It's practically nothing. So that's why the DHHF does charge a slightly higher management fee, but it's still nothing too crazy. It's roughly around 0.2%. So once you've decided on your share portfolio, you need somewhere to actually buy your shares. And this is where stock brokers or share registries and brokers come into play. Classic example, and probably one most well known, is CommSec. Stands for Commonwealth Securities. It's basically CBA Bank. They're a securities exchange branch, and they will hold the shares on your behalf, but the shares are registered in your name, and they are what's called in Australia CHESS sponsored. And CHESS sponsored means that shares that are registered with a stockbroker like CommSec allocated a HIN number by the broker and essentially placed into a share registry. You get a HIN number, and that's your personal number, and that's how share registry identifies the shares that you actually own. So each actual company offers shares to buy in. Legislation in Australia by the Australian Securities and Investments Commission, which is a government branch. So you're pretty safe. The computer share, for example, is where a lot of the companies I invest in actually register their shares. So even if any of these brokers like CommSec or ANZ stocks go down, your shares are still in the share registry. So it doesn't matter. It's not an issue. Now, I don't use CommSec or anything like that because I like to automate Best thing about investing is automation. You want to automate all parts of investing. It's the key to success. It's key to long-term success. It's about setting and forgetting. And my personal favorite is Perla, because Perla allows an automation feature. Perla is a stockbroker just like ComSec, but they allow you to set up a portfolio, and you can actually set the exact percentages that you want the portfolio to rebalance to every time that you set it to buy a certain amount of shares. So say it's $500 a week. You can set it up to automatically send from your bank account without you having to do anything every week, the same time, same day. It will take Perla will take $500 from your bank account and put it into your share automation account on the Perla platform. And once that reaches a certain amount of money, whatever you set it at, say it's $1,000, so that will be every 2 weeks. Once it reaches $1,000, it's going to go ahead. Perla is going to go ahead and buy shares to whichever in your portfolio is furthest away from the percentage you set. Say you've set a share to be 50%, but it's currently only at 40%, and that's the biggest discrepancy in your portfolio. It's going to go ahead and buy $1,000 of that share to try and bring it back up to where you overall want your portfolio to be. And over time, this will slowly work itself out. As your share portfolio grows, and as you keep adding money to it every week, the dividends will come from the shares, and they'll go into your account, and that adds to your share purchasing power, and it just snowballs from there, and you slowly build it up. So if you want a detailed, in-depth guide on how to set up Perla, then let me know in the comments below, and I can go ahead and do that. So that's share investing in Australia. And the same process can be applied to any country in the world. It's just different ETF names, different index names, different ComSec, different share broker names, but the general principle remains the exact same. You want to build, it's just about, Perla says it right there on their website, boring investing for the long term. It's the best way to go about it. This isn't going to make you a millionaire overnight, If you want to do that, you need to start some sort of business, and you need to put a lot of effort in. But if you have extra money lying around and that you don't really need or see a use for, this is one of the best strategies to grow your wealth. I'll be making a video on crypto, because crypto is an entirely different animal in and of itself. I've made a lot of money in crypto, but I've also lost a lot of money in crypto. So I will start a series on how to stay safe and avoid scams in cryptocurrency. Again, if you want to see my current path to financial freedom, check this video out right here. And I wish you all the best on your journey to financial freedom. And we're all gonna make it one day. It just takes time. Till then, peace out.